The global capital markets experienced a big reversal between the last 2 quarters. After flying high previously, REITs fell last quarter. Aggressive Fed rate cuts and U.S. election results bolstered the outlook for the U.S. economy and sent long-term interest rates higher. This weighed on REITs, particularly REITs outside the U.S. After outperforming strongly in the previous quarter rally, our fund did lag decline, with the 2 periods pretty much offsetting. That brings our trailing 1-year return to 5%, more than 200 basis points better than the U.S. That marks 5 consecutive calendar years of outperformance for the fund, or about 650 basis points annualized outperformance, an excellent achievement. The portfolio is really only positioned to invest in the best real estate opportunities we see globally. Lately, that's been across a broad mix of real estate investment companies, with some of our largest overweight positions in non-traditional property types, like cell towers, billboards, cold storage, triple net lease, data centers, and manufactured homes. These sectors give investors the key benefits of real estate ownership with differentiated, structurally attractive growth profiles and especially attractive risk-adjusted returns. We also have meaningful exposure to REITs in Europe and Japan, markets that have really lagged the US, especially with investors going kind of all in on US policy changes, driving growth and inflation higher. We think the risks are more balanced and see exceptional relative value in markets like Europe in particular. To show some high-level information on our portfolio, you can see here that we hold just 18 stocks in the portfolio with an attractive dividend yield of 4.2%, very strong forecasted growth of 3.7% per year for the next 4 years, modest leverage of 34% liabilities to assets, a significant discount to private market values or NAV of 19%, and a similarly large discount to our primary valuation metric, intrinsic value, 18%, which is derived from our capital market-based discounted cash flow model that values REITs as companies. We underwrite to an attractive 17% annualized return for this portfolio on a 3-year hold as well, reflecting the high in-place yields and growth for the company's portfolio. And especially note that on these key valuation metrics of intrinsic value and expected return, the portfolio is far more attractive than the universe of GREITs, as represented by the FTSE Real Estate Index. On the right, you can see that about 55% of the portfolio is invested in the US, with continental Europe and the UK making up nearly 30% combined. And we have very good diversification across this portfolio invested in unique property sectors. We had another company in the portfolio taken over by Blackstone. That would be Shopping Center REIT, ROIC. Blackstone acquired 2 US REITs last calendar year at material premiums to their stock prices, and we owned both companies at material positions in the portfolio. Blackstone is the largest real estate investor in the world, and they see the same value we see in REITs, and in particular, the REITs we own in our portfolio. We added a new retail position into the portfolio in Europe, taking advantage of recent weakness in performance in Europe. And we also swapped our US residential exposure from single-family homes to manufactured homes and gateway city apartments. Our single-family home position has served us very well over many years, but we see a decelerating operating environment, which stands in stark contrast to urban apartments, where there's been very little new supply in the past few years. And the manufactured home sector, or the trailer park sector, is actually a very attractive sector that offers affordable housing options to renters and outside growth potential. A good company in that sector has had a big fall from grace over the past year, but we see likely management changes as a way to right the ship and an opportunity to get good real estate at great value. First, the dynamic that has driven strong returns for GREITs lately is set to continue. REITs are under-owned and trade at undemanding valuation levels compared to equities. The global trend of disinflation is strong, and investors are getting another bite at the apple to buy real estate cheaply. Second, The outlook for real estate fundamentals is quite solid. And that's underpinned by several dynamic real estate sectors that are enjoying strong pricing power and limited or declining levels of competitive supply. REITs are also in a very strong capital position and poised to grow their market share compared to private investors especially. Third, the track record for this fund has been very strong. As you can see on the chart here, we've proven our ability to outperform in up and down markets over a challenging time period, with an unrelenting focus on only investing in the best opportunities we see in the global real estate markets. We expect to continue to prove that we can help investors navigate global markets while retaining the many benefits of including liquid real estate in their portfolios.